If you have money in a real estate syndication right now, or you're thinking about putting money into one, you need to watch this. Deals are blowing up. Investors who were promised 15 to 18% returns are now getting capital calls instead. Sponsors who were all over social media 18 months ago have gone completely quiet. And a lot of good, smart people who trusted this model are sitting there wondering what happened to their money. Here's what most of them don't know yet. The problem is not the real estate. It's not even the market. It's 6 specific decisions that certain operators made on price, debt, structure, reserves that were always going to end this way. The market just made it visible. I've been doing this for over 20 years. Last year alone, we completed over $200 million in multifamily transactions. I've watched every one of these mistakes happen in real time, and I built Elevest specifically to avoid all of them. Today, I'm going to walk you through all 6. For each one, I'll show you exactly what we do differently and what questions you should be asking any operator before you trust them with your capital. Let's get into it. To understand why deals are breaking down, you have to understand the environment they were built in. From 2020 to early 2022, the multifamily market was on fire. Rates were near zero, capital was everywhere, rents were growing 15, 20, 25% in a year in some markets. Values were going up faster than almost anyone predicted. And a wave of new operators, a lot whom had never actually managed a deal through a hard market, raised money and deployed it fast. The market made everyone look smart. Then the Fed raised rates 500 basis points in 18 months. Fastest hiking cycle in modern history. Rent growth slowed. In some markets, it even went negative. Values softened, and those short-term loans started coming due in an environment where refinancing was painful, or in some cases even impossible. The operators who built their deals conservatively, right leverage, right debt structure, right markets, right reserves, they're navigating this just fine. The ones who bet the market would keep going forever, their investors are opening very uncomfortable emails right now. So here are the 6 decision failures that made the difference. Failure number 1, buying at the wrong price. This one sits underneath everything else. In 2021 and 2022, operators were paying peak prices for deals. And the only way those prices made sense was if you assumed rents would keep growing at pandemic rates forever. So that's what they put in their spreadsheets: aggressive rent growth, optimistic projections, numbers that worked on paper but required the market to cooperate every single year. When rents flattened and in oversupplied markets when they actually dropped, those projections fell apart fast. A deal underwritten to hit a 15% return started producing 3% or 0 or even negative in some cases. The foundation was wrong from day one. And once the foundation is wrong, nothing can save it. Here's what we do instead. Every deal we touch gets underwritten at what is true today: current rents, current expenses, current cap rates. If it doesn't work at today's numbers, we pass. We stress test every deal against flat rent growth and against declining rent. If the deal only survives in the best case scenario, we walk away. We're looking for deals that specifically work in the okay scenario, because the okay scenario is the only one you can usually count on. Failure number 2. Too much debt. This is where the most visible damage is happening right now. A lot of operators push leverage to 75, 80, even 85% of the purchase price. And honestly, it looked great for a while. High leverage amplifies returns in a rising market. When values go up 20% on an 80% leverage deal, the equity returns look amazing for investors. But when values soften even a little bit, that cushion disappears fast. An asset bought at 80% LTV with a 10% value decline is now sitting at 89% loan to value. There's almost no equity left, and now the short-term loan is coming due. And here's what really sucks. A lot of these assets are actually performing. Tenants are paying rent, occupancy is solid, the business plan is working, but the operator can't refinance because they owe more than the asset is currently worth at today's rates. So they're forced to sell the asset at whatever the market will pay, which is often well below what investors put in. This is not a distressed asset problem. The real estate is fine. It's a distressed debt problem. The capital structure is broken. Here's what we do instead. We average 68% LTV across our entire portfolio, and that's a deliberate choice. Lower leverage means lower debt service and more cash flow to our investors, and way more flexibility when the market gets difficult. We're not scrambling to refinance because we have a real equity cushion in every deal. That's how we sleep at night, and honestly, it's how our investors sleep at night too. Failure number 3, they had the wrong loan structure. This failure shows up in 2 completely different ways. The first way used floating rate bridge loans with no real rate cap protection. They were borrowing at 3 or 4%, skipping the rate cap, or buying one so far out of the money, it was basically useless. When rates went up 500 basis points, their debt service doubled. Some deals went cash flow negative. The property was not making enough to even cover the loan payments. The second way went the other direction. They locked into long-term fixed-rate agency debt, Fannie Mae or Freddie Mac. It sounds safe, but these loans come with massive prepayment penalties. If you need to sell early because the market shifted in your favor, those penalties eat a huge chunk of your profits. Deals that perform well operationally still deliver bad investor outcomes because the exit was crushed by the debt structure. And both extremes are a problem. No protection on one end and no flexibility on the other. Here's what we do instead. We use bridge debt with a 3-year interest rate cap plus 2 one-year extensions. So effectively a 5-year rate-managed loan. Our cap sits around 4.75%, which means no matter where rates go, we know our worst-case scenario debt service from day one. We're not guessing because we have a ceiling. And if rates go down, we benefit. The cap is a ceiling, not a floor. So lower rates mean lower debt service and more cash flow going to our investors. We also raise meaningful capital reserves specifically to buy a new rate cap extension if we need them. We don't hope the rate environment works out. We budget for it not working out and build the reserve before we need it. That is what engineering a middle path actually looks like. No prepayment penalties, full flexibility to exit when the business plan says to, not when the debt structure allows it. Failure number 4, they were chasing the wrong markets. During the boom years, capital piled into the same markets all at once. Austin, Nashville, Tampa. The story was great, the competition was fierce, and nobody wanted to miss out. But when those markets soften, and some of them are sitting on real oversupply and negative rent growth right now, the concentration of poorly underwritten deals in the same areas made everything worse. The story changed and there was nothing underneath it to hold the deals up. Here's what we do instead. We operate in specific markets with a longevity mindset behind our decisions. Our current markets are the Phoenix MSA, the Dallas MSA, and Greensboro, Raleigh, and Charlotte, North Carolina. We didn't pick these markets because they were trending. We picked them because the data held up across every metric we care about. Sustained population growth, not just pandemic migration. Diversified job markets that are not dependent on one employer or one industry, housing demand that consistently runs ahead of new supply over time, and affordability relative to ownership costs that keeps rental demand strong. Are these markets immune to short-term pressure? Of course not, no market is. But when you underwrite conservatively and structure the deal properly from day one, the underlying demand in these markets is more than enough to support the business plan even when things get tough. Failure number 5. They didn't have enough reserves. Value-add deals always cost more than they budget. I mean, always. I've never done a renovation that came in exactly on budget. Contractors miss timelines, materials cost more than estimated, and something expected shows up. A roof, a plumbing issue, an HVAC system that looked fine until it wasn't. A lot of operators raised exactly enough to close the deal with almost nothing left over. And when the unexpected hit, they had 2 options. Go back to investors for more money, which is a brutal conversation that damages trust and sometimes just does not work, or sell before the business plan was complete, usually at a loss. The root cause was simple. They raised what they needed to close, not what they needed to execute. Here's what we do instead. We build significant capital reserves into every deal from day one, generally between $1 million and $4 million depending on the size and scope of the asset and the business plan. These are capital reserves that are not allocated to anything. They're like rainy day funds that we can use if we need them. And our renovation budgets assume things will go wrong. We build in the cushion before we need it. Because a reserve that gets raised after the problem appears is a capital call. A reserve that exists on day one is protection. And finally, failure number 6. They were raising money before building the skills. This is the one failure that caused all of the others. The syndication boom attracted a lot of people whose real skill was marketing. They built audiences fast, they were great on camera, they raised a lot of capital, but they had not actually built the operational depth to manage deals through a difficult market. And when things were going up, the assets covered for the gaps. When the market turned, those gaps became impossible to hide. These weren't all bad people. A lot of them genuinely believed in what they were building, but they built it backwards. Audience first, operations second. And when the environment got hard, the gap between what they promised and what they could actually deliver was way too wide to close. Here's what we do instead. Operations first, always. The deal, the market, the underwriting, the asset management, the investor communication. That's the job. That's what our entire team and every system we built is organized around. Raising capital is the result of doing the job well, not the other way around. We find deals worth doing, and then we raise the capital to execute them. That sequence matters more than almost anything else in this business. When the deal comes first, every decision serves the deal. When capital raising comes first, the pressure to deploy capital creates shortcuts, and shortcuts eventually cost investors money. Here's something most people are missing in all of this. The distress in the market right now is not just a problem, it's actually an opportunity. When operators who over-leverage and under-reserved are forced to sell, the assets they're selling are often performing just fine. The tenants are paying rent, the business plan is working, but the debt is broken and they have no choice. Those assets are hitting the market at prices that reflect the seller's situation, not the asset's value. We built our model for exactly this environment. Conservative leverage, proper debt structure, right markets, solid reserves. We didn't predict this situation. We just understood that markets are unpredictable and built a structure that does not require the market to cooperate. And that structure is now letting us buy assets that we wouldn't have been able to 2 years ago. Last year, we acquired 9 assets at an average discount of 40% off the market cycle highs. Not one of those sellers wanted to sell. They were forced to sell. And we were in a position to buy because of every decision we made before the market got difficult. That opportunity still exists right now. We're actively buying at these discounts. How long does the window stay open? Nobody really knows. But we're in the middle of it and we're taking full advantage. If you made it this far, you now know more about how to evaluate a syndication operator than most investors who have been in this space for years. Use it. Ask the hard questions. The right operators will welcome them. At Elevest Capital, we're not asking you to take our word for any of this. We're asking you to ask us the hard questions. What is your average LTV? How is your debt structured? What are your rate cap terms? What reserves did you raise at the property level? How do you underwrite rent growth assumptions? And what markets are you in and why? We have specific, detailed, defensible answers to every one of those questions because those aren't questions we dread. Those are the questions we built our entire operation around. The link to book a call with our team is in the description below. And if you want to see how we actually evaluate deals before we buy them, I already made a video on that. The link's in the description as well. I'll see you there.